Is the CPI a fair measure of inflation? Because one of the things I struggle with inflation is I think it's one of those things that's quite relative. Um, it may be a good measure of the general cost of living, the changes in the cost of living month on month for people. But for example, someone like my children doesn't really affect them. But what does affect them is if house prices accelerate to such a rate where maybe they're in their 20s and they will want to buy a house, it's really pushed it out of reach for them. So is the CPI a fair rate of calculating inflation? Should we have multiple calculations?
I think there should be multiple kind of measures of inflation, and in some sense there are. I mean, that's why there's things
Mhm.
like producer price indexes are useful. You can also just look at, what is the raw, commodity index doing? So what are commodity prices doing? That's one of the big factors of inflation. Generally, you don't have strong inflationary periods without commodity prices also going up a lot. But like I said, over the past decade, the problem is that you know the big areas of spending that most people spend their money on have gone up faster than wages and have gone up faster than the official CPI. And so that includes housing, that includes food, that includes healthcare, tuition, childcare, things that you can't outsource or that are not deflated away by technology and smartphones and things like that. And so, whereas on the other hand, your TV got cheaper, your computer got cheaper, but those are generally pretty small percentages of a household budget. And so, some of those other things are really important. Another factor that's weird about housing is that obviously CPI does not really take into account most asset prices, so it doesn't take into account asset price inflation in the
Mhm.
stock market or private businesses. It only partially factors in real estate, but it does it in a weird way. And so you actually have a thing where houses have gone up faster than inflation in most markets, so they've outpaced inflation. But then, for example, because we've been in this kind of multi-decade trend of lower and lower interest rates, including mortgage rates, the actual monthly payment to afford a house hasn't really gone up that much, even though the cost of the house has. And so that can push down kind of the quirky, wonky, the cost of owning a shelter. However, it's unfortunate that that doesn't change the fact that people still have to take on more debt relative to their income in order to afford that house. And so basically, it just means that of the monthly kind of plan that they're doing, more of that at least goes to the house than goes to interest to the bank. But it's basically those policies are still propping up housing prices. And so an ideal case would be to have for especially for new people entering the market, for housing prices to be cheaper than they are, especially on a ratio of like housing price to median annual wages.
Is there any risk whereby we come out the long term debt cycle? And I don't know what point that would be, but interest rates will then start to go up and people might be trapped with payments they can't afford on houses they've taken on with these low interest rates. Is that a serious risk? Is that a serious concern for central banks when setting interest rates?
Well, that was a big factor in what caused the subprime mortgage crisis, back in 2007, which was that these people they bought it, there was predatory marketing, really dumb like things by banks, and then people bought into houses they couldn't afford, and so a lot of them what the way they did it was they had a really really low variable rate,
Hmm.
and so after like 5 years, that had like a contracted thing where it could bump up to a market rate and suddenly they couldn't afford that house anymore,
Hmm.
which they really couldn't afford it from the beginning, but now they literally couldn't afford the payments, and so that triggered this cascade of defaults that happened, and now so that's not a problem for people that have say 30-year fixed rate mortgages or even 15-year fixed rate mortgages. I know different countries all have different kind of
Hmm.
practices for what is normal for kind of a housing financing scheme. And so it is a factor for variable rate mortgages. Um, and so generally after long-term debt cycle, usually interest rates normalize. But there's always a big question of what is a normal interest rate, and obviously it changes based on what society is doing, what demographics are like, whether there's a period of kind of technology boom happening. Like like technology doesn't really happen linearly, right? We have these
Hmm.
big discoveries like the using oil or the internal combustion engine or electricity or the internet and smartphones, right? So you have these kind of bursts of growth, and that can kind of temporarily suppress costs for a number of years. But over time, interest rates should eventually normalize, but I wouldn't expect that anytime very soon. And it's one of those things where, if you had a theoretical environment, like you say the free banking era in the United States, where you didn't have like a centralized yield setter, then you have different institutions setting different rates, which is actually kind of what we see in the the crypto lending markets, where you have different entities setting rates. Some of them are more conservative than others, and so you basically are willing to accept a lower rate. Other ones are push that more, and so you kind of saw that in banking systems in some periods of time. Whereas lately we've had a more centralized rate setting mechanism, which doesn't necessarily correlate with the actual what the cost of capital otherwise would be.
Right. Okay. Last question on inflation, because you mentioned there the producer rate at around 7% would hint to a maybe 3 or even 4% CPI inflation rate. What numbers are concerning? I know it's for different people. What numbers would be starting to say? I don't know if it alarms you, Lyn, but makes you really kind of think, okay, there's a problem here. What numbers do you think concern the government, or do they not? I mean, is this what we've talked about previously, where they want higher rates so they can clear their debts? What numbers perhaps should people listening be concerned about?
It's yeah. So for me,
Sorry,
it really
tricky one.
depends on it depends on what assets you are focusing on. And so, from what I'm looking at, the math shows that about 3% CPI this spring is kind of just the entry fee, right? So that's like from base effects alone and kind of moderate inflation, we should touch around 3%. Now, if you were to get 5%, yeah, that means there's more than people are expecting. And so there's numbers like that to watch out for. Now, from the government perspective, they yeah, obviously different central banks have different policies. Right now, for example, they generally are looking for more inflation, and it's their way of measuring it. And so, for example, the Federal Reserve uses core PCE, which kind of like the CPI basket is not a it's not a fantastic gauge of inflation, but from their perspective, they want that to run hot. And so the Fed's long-term average annual inflation target is 2% a year. The way they measure it, it generally undershot that for most of the past decade, and so now they want to overshoot it. A certain period of time so that they can have it so that it in hindsight it averaged 2%, and that's the way they measure it. And so the challenge for them is it looks really bad if say PCE is like 3% and there's say we're still going to hold interest rates at zero, right? Because that means if you're holding money in the bank, then based on the way they're measuring inflation, you're losing 3% a year.
Mm,
And so and also like there's concerns of, well, if inflation gets out of control, is the Fed going to let that? How hot are they going to let it run? And so they have a delicate balancing act of trying to you're going to push the narrative that it's transitory, and they're also going to push the narrative that they quote unquote have tools in case inflation gets out of control. Now the problem is that their tools are also things that would crash a lot of these bubbles that we see, and
mm,
that's kind of goes back to how as we look later this year, we have to be we have to be mindful about some of these central banks maybe trying to taper some of their activities, because they could start causing some fun activities in the market, you could say, where the bulls and bears kind of wake up a little bit and things don't operate so smoothly, and so that's how I'm kind of watching that play out.